To what extent do the SBA's lending, the Small Business Administration lending and investment programs, bridge gaps in private markets for access to financing during periods of tighter credit conditions?
Well, SBA financing, I'm sure, does help, but the recognition is that it's actually only a small part of actual financing of small businesses, so only the order of 5%. So clearly what's really very key is the overall health of the U.S. economy and also the overall health of the financial system to be able to provide the credit to small businesses.
The Federal Reserve makes policy decisions weighing both inflation and economic growth. During the September 18th Federal Open Market Committee meeting, the decline in inflation was expected to be sustained throughout the year, but needed to be watched carefully. The meeting minutes stated that inflation remained a risk, due in part to the continued weakness in the dollar. How has the recent slide in the value of the dollar affected your inflationary expectations?
Well, clearly, when the dollar declines in value, that increases both the prices of imports, what we buy from abroad, but actually also increases the demand for exports and therefore prices for exports. In fact, we think of these as just tradable goods, and it actually would lead to higher prices in those goods. However, the pass-through of the effects of exchange rate depreciation are very much affected by how anchored inflation expectations are. If inflation expectations are well anchored, which is extremely important and in fact part of what the Federal Reserve needs to achieve and has achieved in recent years, then we find that the impact of a dollar depreciation on the overall price level is actually quite limited.
Sir, with a weaker dollar and inflation concerns expressed by the board in meeting minutes, are some inflationary risks being ignored?
Well, I hope not. We definitely don't want to ignore them. It's extremely important to the health of the economy that inflation, in fact, it remains contained. This has been one of the great successes of the Federal Reserve System in recent years, and actually also in other central banks throughout the world. Indeed, if you anchor inflation expectations and anchor inflation, it actually gives you more flexibility to deal with negative shocks to the economy.
We all know that businesses of all sizes must plan and account for inflation. Would you please describe to us your view on the idea of an explicit inflation target, and its likely effects on small business ability to make informed decisions?
Well, at this stage, the Federal Reserve has been discussing communication strategies, so I really don't want to comment on the issue of inflation target. What I will say, however, is...
But let me ask you, can you discuss how inflation target impact the small business sector?
Well, I think the issue here is, rather than thinking so much of an inflation target impacting the small business sector, the way I would think about this is the control of inflation and how that impacts the small business sector. That clearly having price stability, which is part of our dual mandate, not only do we care about price stability, but we also care very much about what happens to economic growth and employment. But having price stability actually makes it much easier for small businesses to plan and make better investments and therefore do better. Actually, I come from a small business background. I actually maybe even was in your district, that there was actually manufacturing in Manhattan. Quite extensive manufacturing, which of course is no longer there. And I worked in my father's plant, and in fact, it's now a restaurant, by the way, which is what has happened to Manhattan. It was on West 14th Street, so I don't know where that is relative to your district. But clearly, the years where in fact inflation was highly volatile actually created tremendous problems in terms of planning. So I saw this by talking to my father every day at the dinner table. When you have a stable price environment, it makes it much easier for businesses to plan. Secondly, when you have stable prices, it means that interest rates actually stay lower. So part of our so-called dual mandate, there's a third element to the Congressional Act for the Federal Reserve, which actually said not only do we want to have price stability, maximum sustainable employment, but also that we should have stable interest rates. Well, in order to get that, you also have to, in fact, make sure that inflation is under control. also we find that when central banks control inflation better, it means that you can be more aggressive when in fact there's negative hits to the economy. But always you must keep your eye on the inflation ball to make sure that you do not end up in a situation which is ones we've had in the past, particularly in the 70s, where you actually had both high inflation and actually an economy that did not do very well.
It is no secret, sir, that the turbulence we have recently witnessed in the markets grew out of the mortgage market. The Federal Reserve lowered the target federal funds rate at both of its last meetings in response to tightening credit conditions that could restrain growth. Housing prices have slid, vacancy rates are rising, and home starts are declining. As a result, several prominent Wall Street firms had unexpected record write-downs. Given the length of a typical foreclosure process, is it possible that the worst is still to come?
Well, clearly that the situation in the housing sector is one that we have to monitor very closely. The weakness in housing has been a significant drag on the economy. In the second half of this year, on the order of about 1.5% of GDP. So this is a very significant impact. And clearly the housing market is not out of the woods yet. That there's a big overhang of inventory, a lot of houses that builders have built and they have not yet sold. And this is actually a depressing effect on the housing market. So one of the difficult things for a central banker is that you actually have to look at the economy, and unfortunately we don't have a crystal ball. Luckily we do have a very, very strong staff at the Federal Reserve to help us think about where the economy will head. And particularly monitoring the housing market and the housing sector is absolutely one of the key things that we have to do now, because we do have to worry about the fact that the housing may not do well in the future, and when will it turn around?
And isn't it true that financial institutions cannot predict as to the extent of the foreclosure crisis will have on them, since the process could take from 6 months to a year?
Well, I'm sure they do have some forecasts of how serious these foreclosures are going to be. It's clear that, in fact, there are going to be a lot of foreclosures down the road. And some of that has already been taken account in terms of the predictions in terms of the earnings of these financial institutions. This is actually part of the nature of lending, that you sometimes do make mistakes, and in fact, clearly in this instance we've had a lot of mistakes made in terms of people not being able to pay back loans. And this is something clearly that the financial institutions do have to worry about, and something that we have to be concerned about as well. Well,
let's take, for example, that in January and July of this year, Chairman Bernanke testified before the House and Senate banking committees to report on the conduct of monetary policy. In both hearings, the chairman expressed confidence that weaknesses in the housing market will not spill over in the wider financial markets. Clearly, the perspective was overly optimistic. If the downturn in the housing sector continues throughout the next year, what effect do you believe this may have on the broader markets?
Well, clearly one of the things that has happened is that the problems in the mortgage sector have actually spilled over more widely to the financial markets in general. Indeed, when we think about what financial markets are supposed to do, they're basically solving information problems. They're trying to allow people to take funds and give it to people who have good productive investment opportunities. And this is particularly important in the small business sector, which is one of the key drivers of the U.S. economy. It's really quite extraordinary how vibrant the small business sector is in this country.
Will this affect commercial lending for small businesses?
So there are clearly a whole set of issues here. But one of the things that happened is that the markets had much more confidence in their understanding of not only what was going on in the mortgage market, but the very complex products which were related to mortgages. And we've seen, in fact, that these surprises have meant that the financial markets have actually had a disruption, and that does have impacts on small businesses. In particular, we have seen a tightening of lending standards. That we have a survey of senior loan officers, and there clearly has been a tightening of lending standards. However, it is important to note that because the problems in the financial markets have actually been more in the securitization part of the markets, and small businesses typically do not get credit through securitization the way some other sectors have, that the impact seems to have been greater for larger firms rather than for smaller businesses. So there clearly has been an impact that this is one of the issues in terms of an economy that's weaker than we might have expected a little while ago. It clearly is one of the reasons why the Federal Reserve has acted to lower the federal funds rate by 75 basis points in order to try to forestall or counteract the negative effects from this credit tightening.